COVID-induced lockdowns meant that many sectors saw business grinding to a halt, with people simply being unable to consume their goods or services. Take the hospitality sector for example. While people might have had the money to go out and eat, and even the desire to do so, they simply couldn't, as COVID forced them to shelter inside their homes. This led to the build-up of pent-up demand, and it also laid the grounds for the revenge buying phenomenon that would follow the easing of lockdowns. Coming to the present situation, with the sharp drop in COVID-19 cases in the past few months, states have eased the lockdown-like curbs they had imposed. And with the economy opening up, various sectors could end up benefiting from the pent-up demand mentioned earlier. Picking stocks in these sectors is known as playing the unlock trade or theme. But how prudent is it to bank on such a theme? Let's delve into the matter. Starting with the third quarter of the financial year 2020-21, investors have seen unlock trades at various points in time. Whenever lockdowns have been eased, traders have taken long positions in consumer-facing businesses. With the receding second COVID wave and the approach of the festive season, more unlock trades are happening now with recent interest in consumption-oriented stocks. However, is the optimism justified? The low base is undeniable. This will boost results. There are other positive indicators too. Inflation is still high, but it eased in July. The index of industrial production for June was up 13% year-on-year after falling 16.6% in June 2020. We saw positive values for manufacturing and services purchasing managers indices in July. We also saw strong goods and services tax collections in July. July car sales were also good, both year-on-year and versus June. This was true for two-wheeler sales as well. However, both two-wheeler and car sales were well below the levels seen in July 2019. Moreover, middle-class demand could be affected as Maruti Suzuki has announced price hikes to cope with rising input costs. But there are negatives too. These are as follows. With 32% of the eligible population having received just one dose, India's vaccination drive is well below the level needed for herd immunity, and another wave of mass infections could be triggered by the festive season. Also, consumer confidence surveys indicate poor sentiment. The Reserve Bank of India's Consumer Confidence Service in July said most households reported lower income and worries about inflation. The current situation index is close to a record low, while the future expectations index is slightly positive. Meanwhile, around two-thirds of CEOs of large companies polled by industry body CII in August said they expected FY22 GDP growth to be 9% or less, which was lower than official estimates. A growth rate of 9% on the back of a 7% GDP contraction in FY21 would only pull GDP back to near FY20 levels. According to the Retail Business Survey by the Retailers Association of India, July retail sales were at 72% of the pre-pandemic level of July 2019. Clearly, there's a long way to go for recovery. According to Fitch, consumption recovery would be complete only in FY23. Putting all this together, we can expect consumption growth through the second half of FY22, but the growth rates could be disappointing. Given a fast run-up in stock prices due to unlocked trades, one should be cautious about increasing exposure. Keep in mind that the valuations may be unsustainable.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.